If you are a current or former Gartner employee and you are enrolled in the Gartner 401k plan, you have very likely been pre-selected into the Vanguard target date investment strategies. These are 3 reasons why those target date investment strategies may not be the best fit for you. The first reason is that they do not allow at all for personalization or customization to your individual specific financial planning needs or your risk tolerance. The target date strategies that Vanguard creates are based off one single factor, and that factor is your date of birth. They know your date of birth through an information share that Gartner HR has when you enroll into their benefits program. They are building your investment strategy off that one single input, your date of birth. They are assuming that based off your current age, that you are going to retire at X date in the future. From that input, they are building an investment mix of stocks and bonds that changes roughly every 5 years as you move through your journey towards retirement. As you're younger, it generally has you more invested in stock, and as you get closer and closer to retirement, it moves you more and more into the bond investments that they have inside their strategies. They call this a retirement glide path. You start more aggressive, you move over time to being more conservative. It sounds like a great idea, but it misses a few key considerations. What is your personal risk tolerance? 2, what is your risk capacity? Those are 2 different things. And 3, what else do you have going on in your retirement plan? Right? What do you have for outside assets? What does your spouse have? What does your saving strategy look like? It doesn't know any of those things, but it's building an investment strategy based on your date of birth, and that's it. If you're a current employee and you've worked there for 5, 10, 20 plus years, this account is very likely your most important retirement asset. It's really, really important that you get it right, and to have a preset mix of investments that's only looking at your date of birth is probably not the best way to do this. As you're moving through your retirement journey and getting educated on these different topics, one thing I hope stands out, and that is your financial plan is incredibly specific to you. The investment mix that you ultimately decide on determines over 90% of your risk and almost all of your performance. It's way too important to have it be preset for you based on one factor, which is date of birth. The second reason why target date funds might not be the best option for you is because they are very limited and specific in their investment choices. To start, Vanguard, when they build out their target date strategies, they can only use investment options from one provider, and that's Vanguard. All of the investment options inside those target date strategies are proprietary. Vanguard is an excellent provider. They have an amazing reputation. They revolutionized investment planning about 50 years ago by introducing the index investment choices, but they are not excellent at everything. Vanguard has excellent strategies in some areas, average in others, and poor in some areas as well. No investment company out there is excellent in all of the areas. Vanguard is world famous for one particular type of strategy, and that's an indexed option. An index option is designed to be very low cost, which is a great benefit, and it's designed to track as close as possible the performance of a specific group of investments. Indexing in other asset types has not been such a great investment, especially over the last 5 or 10 years. For instance, as you get into your 50s and 60s, you might have upwards of 40 or 50% of your investments inside the Vanguard Traditional Bond Index and the Vanguard International Bond Index. The Vanguard US Bond Index over the last 5 years, as I film this in 2025, has a negative total return. A negative total return. It has made no money in the last 5 years. With upwards of 30, 40, or 50% of your investments going into these bond indexes, we need to be a lot more thoughtful about how we're representing bonds inside of a retirement strategy. These last 5 years, we've had high inflation and rising interest rates, and those investments are just not equipped relative to others to deal with those in an optimized way. We want to be a lot more thoughtful about how much interest rate risk we're taking on and how much interest we are getting paid. We believe in a dynamic called prudent yield. Are we getting enough interest for how much risk we're taking? Those things really need to line up. In the bond index, they don't. The US bond index in general owns a lot of long-term US treasuries. And as the fiscal situation of the United States, looking out with our national debt, is not as rosy as it once used to be, those long-term bonds are put under pressure, and they have been now for a couple of years, and that's only continued to be the case in 2025. Vanguard also allocates a significant amount of your stock exposure to international stock. US stock has essentially outperformed international stock about every year for the last 15 years. Markets do move in cycles, and international stock will have its time, but it has a very heavy allocation, especially for younger people, into international stock that has significantly underperformed large US stock. The target date strategy also gives you no ability to allocate more dollars into smaller US companies, mid-sized US companies, or industry-specific investments like real estate or commodities to build out a more diversified approach for the decade ahead. The third reason why you might want to consider not using a target date fund is it has specific challenges when it comes to taking money out. When you get to the stage of your life when you're no longer working, the paychecks have stopped, you're now thinking about how am I going to take this retirement savings vehicle, my 401k, and make it create income for me that's sustainable for the rest of my life, which could be a 20, a 30, a 40-year retirement. One of the challenges with the target date strategy is when it comes to taking that money out, say you need $25,000, is going to sell $25,000 worth of the shares of the strategy, but inside that $25,000, it's going to be a mix of US stocks sold, international stocks sold, bonds, and cash to create the $25,000 that you need. It sells all the investments inside the strategy in a pro rata proportionate way. This creates a really large challenge for retirees. Say markets are having a particularly difficult time. Maybe it's the early 2000s or 08, 09 or COVID or April 2025 when stocks are under significant pressure. You want the ability to intentionally select, I don't want to sell any of my good long-term growth assets like stock. I want to sell specifically the investments invested in the bond aspect of my portfolio. Those assets have maybe gone up right now. That's what I want to sell to create the cash that I need. I do not want to be a forced seller of my long-term growth assets or my stock to create this cash right now. By selling shares of the target date fund, you are recognizing a permanent loss on those growth assets at a crummy price. You are selling them, you are crystallizing your paper loss, and you're making it permanent. Ideally, you would have 5 years of your expected cash needs intentionally allocated not in stock. You want it in safer, more secure, lower volatility assets that you can say, this is what I'm going to sell to create the cash that I need. This type of bucketing strategy inside your account allows you to have the growth assets, your stock, the time that they need to recover their value during challenging market periods. So at a later date in time, when they're at a better price, you can sell them and refill up your short-term bucket for the next 5-year period. But you never want to be in a place where you are a forced seller of good growth assets at a crummy price. The target date strategies do not allow you that flexibility. You have no ability to go in there and say, just sell these assets to create the $10,000 I need to fix my roof. They sell everything in proportion. One of the biggest risks to retirees is that markets work against you in the beginning of your retirement. You need to have a proactive strategy to be able to distribute money from your savings to create a sustainable long-term income stream. Being a forced seller of target date shares and selling your stock and selling your bonds all at the same time, regardless of market conditions, is a way that you can put your retirement at risk. Those are 3 reasons why you might want to consider building an alternative investment lineup rather than using a target date strategy, specifically in the Gartner 401k plan. If you have more specific questions about your 401k plan and you want to talk about it with a specialist who works specifically with Gartner employees, feel free to go to our website and book a time with us to do that. I'd be happy to take you through what you're doing today and what you might want to consider moving forward as you prepare yourself for a successful retirement. Thanks so much for joining and watching this video. We look forward to creating additional content specific to Gartner employees to help you on your retirement planning journey. If you found this content helpful, you found it informative, awesome. Subscribe to the YouTube channel, connect on LinkedIn. I'm going to be putting out more content just like this. If you have other questions that are a little bit deeper that I wasn't able to dive into in this video, or you have questions about how it pertains to you individually, awesome, totally okay. Go to the link on my website. There's a space where you can book some time with us. I'd be happy to talk to you about it. Help you as much as I can. It's complimentary. I'll point you in the right direction. If you have other questions, we can tackle those too. Thanks so much for joining us. Have a great day.